Hi guys, welcome again. And this discussion is focused on a small topic in your SBR syllabus and also in your Diploma IFRS syllabus, which is IFRS for SMEs. Now, what are SMEs? SMEs are small and medium enterprises. Now, when I say small and medium enterprises, the first question that would come to anyone's mind is how do we define a small or medium enterprise? What constitutes small? I mean, for a middle class person like me, 1 crore is a big number, but maybe for Ambani's, 1 crore is like what? Peanuts, chiller pesa. So the words small and medium can be misleading if they are not defined very, very clearly. In every country across the world, there are certain specific provisions that are meant for small and medium enterprises. And why do you need special set of provisions for small and medium enterprises? Please understand. See, the government doesn't want businesses to be bogged down by a lot of compliance. Today, if there is a new business, there is a fresher business that is starting in the economy, somewhere there is a feeling that these people they don't need to be tied down by so many compliances that their entire time goes in the compliance process and they cannot focus on growth of the business and building the economy overall. So how do you help a small and medium enterprise grow and survive? If you are the government, you will give them a lot of relaxations. You will not make the compliances so stringent for them. This would be your basic idea of giving relaxations to SMEs. Maybe, say, I mean, if other companies, bigger companies have to file GST returns on a monthly basis, the government might say that such small and medium enterprises should do it on a quarterly basis. That way, the burden of compliance is reduced and they can focus first on building the business. So when it comes to accounting standards, again, the approach is no different. This is the basic principle that is used in developing the idea of small and medium enterprises. To give you some context, if you look at IFRS in its entirety, say for example, if you're looking at IFRS 16, which is a complex standard to apply, IAS 12, which is a complex standard to apply. Now imagine you are a small enterprise whose annual turnover is 2.5 crores, and you have to prepare financial statements which are fully compliant with the accounting standards. You don't have the necessary resources and the skill sets to get that done, which means you will have to hire someone from outside. This person whom you hire from outside, he will spend a lot of time and effort in preparing financial statements which are IFRS compliant. Now, naturally, if that person is spending so much time and effort, you will have to pay him a higher amount. And ultimately, these financial statements are not for distribution to a wide number of shareholders. See, Reliance has lakhs and crores of shareholders, but someone like a small entity, say Plutus Education for that matter, we don't have so many shareholders and they are not making life altering or finance level altering decisions based on the financial statements. So the distribution network is also pretty limited, and the intended people are also limited. People who are going to look at this financial information for making decisions, which is why it becomes critical that the government relaxes some of the provisions of the accounting standards when they are being applied to financial statements. And we understand the cost benefit analysis very clearly. For example, if you're looking at a smaller business, okay, the overall cost that you are incurring for making the financial statements compliant with IFRS will far exceed the benefits you derive from making the financial statements compliant with IFRS, which is why a highly relaxed approach for small and medium enterprises when it comes to financial reporting has been introduced. Okay, so not all businesses have profit as their main focus, and even if they do, their financial statements are not for circulation and distribution to a large number of people. They have limited number of shareholders. Not all entities are listed on the stock exchange. Not all entities have not all entities have public interested in them on the same level. So it is necessary that they get some relaxation. The cost involved in this activity and the effort and the time involved in this activity is far too high, which is why the International Accounting Standards Board has released a simplified form of accounting standards for small and medium enterprises to apply. Okay. And This, of course, will depend from country to country. How do you define small and medium enterprises? Like right now in India, these provisions are, of course, they are introduced in a different manner. Like not all accounting standards are applicable for all entities. And that decision is also made on the basis of the overall turnover and capital and all of those parameters. India will define small and medium enterprises differently. UK will define small and medium enterprises differently. USA will define it in a different way. The local geo the local laws of any country are not a focus point for your SBR exam. What is a focus point is the relaxed form of applicability, which is there for all the entities. So the first thing that we'll discuss is what are the relaxations that are given to small and medium enterprises when it comes to compliance with different accounting standards. Let's go one by one. If I'm talking about IFRS 16, which is accounting for leases, okay, leases are recognized by lessees using a single accounting model. And for a lessee, it doesn't make a difference whether the lease is a finance lease or an operating lease. If you remember, when we were doing IFRS 16, the finance lease and operating lease discussion was relevant for the lessor, not for the lessee. But in small and medium enterprises, lessees must classify leases as operating or finance lease. Only if it is a finance lease, the lessee should apply lease accounting, right of use asset account debit to lease liability wala entry. Otherwise, if it is an operating lease, they should simply do rent to cash and move on. Okay. For operating leases, excuse me, for operating leases, the entity should simply record the rent entry and no need to record right of use asset and lease liability. Okay. So this is a relaxation. Then IAS 23 borrowing cost. See, in case of borrowing costs with respect to qualifying assets, if certain conditions are fulfilled, then borrowing cost is capitalized. What do I mean by capitalized? Borrowing cost is included in the asset cost. Now it could be a non-current asset or it could be inventory, but the borrowing cost is included in the asset cost. If I'm talking about the SME standard, as in for small and medium enterprises, all borrowing costs are recognized as an expense in P&L. Okay. All borrowing costs recognized as an expense in the P&L account. And capitalization of borrowing cost is not allowed. If I were to talk of IAS 38, development costs that meet the IAS 38 criteria are recognized as an asset. But if you are a small and medium enterprise, you are not supposed to, or you are not expected to spend time in analyzing whether it meets the criteria for IAS 38 recognition. All development costs should be recognized in P&L. You are not supposed to capitalize that. They have made your life easier. Okay, then intangible assets may be measured using the revaluation model when there is full application. For small and medium enterprises, no need to get into, complex calculations. What you have to do is you simply have to apply the cost model and move on. In IAS 19, employee benefits, the remeasurement loss or gain is recorded through other comprehensive income. In case of small and medium enterprises, an entity must make an accounting policy choice to recognize all actuarial gains and losses in either P&L or OCI. So they have simplified the whole process for you. You have the choice. Either you can recognize it in P&L or you can recognize it in OCI as well. But truth be told, for small and medium enterprises, now these calculations are not so critical or so material in the financial statements. So you will not even have IAS 19 remeasurement gain or loss or actuarial gain or loss in most of the situations. So in a way, that calculation itself is not going to be there in the financial statements. Okay. Financial assets are classified as amortized cost, fair value through P&L or fair value through OCI, depending on the cash flow and the business model test. Basically, if you remember, you ask yourself the question, why am I holding the financial asset? If it is for trading, then it is recorded through P&L. Fair value through P&L. If it is not for trading, maybe amortized cost approach could be used, or in case of equity, fair value through OCI approach can be used. Financial assets, but if you are a small and medium entity, they are recognized as amortized cost or fair value through P&L. Impair basically, so these are the only two categories, and impairment requirements reflect an incurred loss model. In IFRS 9, if you remember, we did the calculation of expected credit loss. We calculated credit loss under different circumstances, then we included the impact of probability, then we calculated the expected value loss. That was expected value, something that could happen in the future. If you are a small and medium enterprise, you are not supposed to apply that. All you have to do is record only the incurred loss on financial assets, not otherwise. If I were to talk of IFRS 15, revenue from contract with customers, this requires that the revenue is recognized when control passes. You know, when it comes to transfer of control, there are quite a few conditions that have been laid down. But for small and medium enterprises, you are not supposed to apply that slightly complicated model. So if the risk and reward of ownership has been transferred to the other party, then you can say that revenue should be recognized. In case of IFRS 15, risk and reward is one of the indicators to decide whether control has passed. But simply risk and reward passing on to the other party does not mean that control has been transferred. So again, for small and medium enterprises, you see a relaxation. Then, uh, joint control, we did that in one of our previous sessions, joint venture and joint operations. Jointly controlled activities are joint arrangements. In for proper application of IFRS, you have joint operations and joint ventures. You know the accounting treatment for both. But jointly controlled activities are joint ventures classified as jointly controlled assets, jointly controlled operations, or jointly controlled entities. Jointly controlled assets is just two entities controlling an asset. This is an even more relaxed form of recording a joint operation. Okay, now the thing is, you will not be tested on the numerical aspects of small and medium enterprises, but this will be tested as a theory question, which we are going to take up in one of our lectures. For associates and joint ventures, in the consolidated financial statements, equity accounting is applied to associates and joint ventures. But in consolidated financial statements of a small and medium enterprise, associates and jointly controlled entities are measured at cost or fair value. That is again quite a lot of relaxation, because equity method of accounting will take a lot of calculation and a longer time to apply. Measuring at cost or fair value is not that difficult and does not consume so much of your time. Now, when it comes to goodwill, consideration is, how is the consideration calculated? Consideration is the calculation, in the calculation of goodwill excludes acquisition cost. Contingent consideration is included at fair value. If you are a small and medium enterprise, contingent consideration is included only if payment is probable and the amount can be measured reliably. If the chance of that payment is less than 50%, it is not included. Consideration in the calculation of goodwill includes acquisition cost. Okay, which is not, the acquisition costs are not included in the calculation for a regular full IFRS application. But you know, in the formula fair value of consideration paid, there, if it is a small and medium enterprise, you should also include the acquisition cost. When you are calculating NCI, you have two options in case of full IFRS application. Either you can measure it at fair value or as a percentage of net assets of subsidiary. If I'm talking about a smaller entity, small and medium enterprise, then NCI is measured only as a proportion of identifiable net assets. It is not measured at fair value. Okay, then impairment and amortization. In case of a regular full IFRS application, goodwill is not amortized annually but is tested for impairment annually. But if you're a small and medium enterprise, you will assume that the goodwill has a maximum useful life of 10 years and it is amortized over that 10-year period. Okay. So again, three key differences in goodwill. When it comes to foreign currency transactions, foreign exchange differences on transactions of a foreign operation are recognized in OCI and reclassified to P&L. This is one of the last topics that we did in case of consolidation of a foreign subsidiary. Okay, but in case of small and medium enterprises, foreign exchange differences are recognized in OCI but are not reclassified to P&L, so that reclassification is prevented. IAS 40 investment property is measured using either the cost model or the fair value model. The selected policy is applied to investment property. Uh, so in IAS 40 investment property, you have options of cost model or fair value model, and you should apply that model, which basically reflects the economic reality of transactions in your business. However, when we are talking about a large scale enterprise, when we are talking about a larger small and medium enterprise, you should use the fair value model only if the fair value measurement can be done without undue cost or effort. So if you look at this list, okay, this is a comprehensive list of the difference between the full IFRS standard and the SME standard. Please remember that this is a differential list, and at most what you can be asked is a theoretical expectation that what is the difference in terms of treatment in a full IFRS application and application for SMEs. Or another kind of question that can be expected is justification of the IFRS for SMEs. Why do you think you need a separate standard, and why can't you not work with the full IFRS application? Now, the purpose of a set of accounts is to provide information to users of financial statements, which is useful in decision making. But some rules are very complex. And these complex calculations of expected credit loss and all of that, these don't make sense for a small and medium enterprise. So there is a need to have this simplified gap. Or not all agreements that a small and medium enterprise enters into for renting out premises have the nature of a lease agreement. So for them, that relaxation makes sense. Also, in these small and medium enterprises, the owners are basically family members and they don't need that level of information, because the owners themselves are directors, they are the ones who are running the show. So it appears like a company, but it doesn't have that level of complexity at all. And the users don't need to make such complex decisions which will require this level of detailing and granular information. So in that case, a modified gap basically makes everyone's lives easier. But then the issue of comparability will arise. Large, if you are comparing the performance of a larger entity against that of a smaller entity, because the accounting standards applied are not uniform, the comparability would become difficult. And small and medium enterprises, they might find it difficult uh, to apply, but it is not something that will the argument against it says ki it's not necessary that it will require so much cost and effort, so there is probably no need to give a modified or a simplified version of the accounting standards. Now, they basically don't have a lot of these challenges, like something like segment reporting, for example. Small and medium enterprises don't have segments, or all of these complex calculations of ECL will not only be there. So, what's the point of relaxing so many things when most of these transactions are not applicable only? Okay, and for companies already in existence, it might be the case that before this modified version of the SME standards came into existence, they were already compliant with proper accounting standards, full disclosure and full presentation based. And now it becomes very difficult for them to move from that full disclosure state to this modified easy disclosure state. And then again, they will have to spend time in moving from one system to another. So yes. Again, these are common sense based arguments for and against a modified gap, and something like this can be tested in your SBR exam. There's a question in the exam kit that we are going to take up, which will basically employ the requirements of the SME IFRS. Okay, watch the video, and if you have any doubts, do let me know in the comment section.